All right, Canadian inflation cooled to 1.8% in December. But with the threat of U.S. tariffs on the horizon, will the Bank of Canada need to continue its rate-cutting cycle? Joining us now to discuss is Robert Both, Senior Macro Strategist with TD Securities. Robert, welcome to the show.
Thank you, Anthony. Yeah. Certainly no shortage of things to talk about today.
Yeah, okay. So it was a busy day in Washington yesterday. Where do things stand right now on tariffs?
Well, I think, with the president's message last night, we've really just gone back to where things stood yesterday morning. Now, heading into inauguration, there was a lot of uncertainty about, when we could expect news like this. Some had expected those announcements to come, in the inaugural address itself. There was actually very few mentions of, tariffs or, restrictive trade policy in Trump's speech, but certainly it does feel like we were drawn into a bit of a false complacency there. It only took until 8 or 9 p.m. for Trump to begin discussing tariffs again. And, even with that February 1st date attached to this, we still do see this as more of a negotiating tactic. There is still, another 10 days for Canadian officials to try to talk the U.S. down from these tariffs. And there are still, a number of grievances, if you will, that the U.S. would like to address before USMCA is renewed in 2026.
Okay, so looking ahead, what scenarios are you watching for closely, and how damaging could this be for the Canadian economy?
So I think the first scenario we need to look for is just, is this the real announcement, or is this just kicking the can and we're going to see another headline on February 1st that promises tariffs imposed in March? So, that is just sort of Trump's style of negotiating. He does like to keep people guessing. So the first thing we need to see is, is he serious? Are there tariff measures coming on February 1st? And from there, it's a pretty quick jump to, what is that impact, or what is that rate? Are we talking about 10%? Are we talking about 25%? And is that applied to, a broad or all Canadian exports to the U.S.? Or are we talking about carve-outs for energy products, for, auto parts, anything else that the U.S. might deem more important to its own domestic economy?
Okay, and I know tariffs is quite a big deal. That's not the only information that has come out. We did get the latest Canadian inflation report this morning. Take us through the details.
So the high-level print headline inflation slowed to 1.8% year over year in December. That was a little bit softer than we were expecting, but it was in line with the market consensus. Now, the reason I think that it was perhaps a little more hawkish than just an on-consensus print is that 1.8% year-over-year rate was with the exclusion of HST on a number of household goods and services. So you saw very large declines in prices at restaurants, in alcohol, children's clothing and footwear, and some components.
I think this latest chart is showing some of those impacts here.
Certainly. So you see that in the change between where year-over-year inflation was in November and December. That is just the tax cut hitting inflation here. And if you look through some of that impact, that headline print would have been considerably stronger in December. So the Bank of Canada knows that headline inflation is going to be noisy with these temporary HST exemptions coming into place and then rolling off over February and March. So they are going to remain very focused on core inflation over the coming months. And that's why I say where we think it was a little more hawkish. Those core inflation measures that the bank focuses most on, those rose by about 0.3% month over month. They've also been coming off a fairly strong period over October and November as well. So on a 3-month annualized basis, core inflation in Canada is now running at about 3.5%, which is outside of the BOC's comfort range.
It's a little hotter than they expected. Yeah. So with all that in mind, what are you expecting from the Bank of Canada, which meets next week on rates?
Well, even with that hotter inflation, I think there is enough softness, enough observable slack in the Canadian economy to carry through with a 25 basis point rate cut next week. But once we to see that cut materialize, the Bank of Canada would be at 3%. We're getting pretty close to the midpoint of their neutral range. So the bank thinks neutral is 2.75. That would be a rate at which policy is neither adding to growth nor subtracting from it. But there's a lot of uncertainty where we are in that range. So the bank doesn't want to cut too deeply and then potentially need to take those backs. The data is telling us we might be a little closer to neutral already, just given that we have seen signs of recovering growth. We have seen this reemergence in the bank's core inflation measures. However, you're still seeing quite a bit of slack in the labor market. The Bank of Canada still thinks there's a pretty material output gap. So there is going to be a pretty high bar to pause at the upcoming meeting. And then once we get beyond January, obviously we've got a pretty large shadow from trade uncertainty weighing over the near-term path.
Yeah. How are they thinking about tariffs as they consider their policy going forward, the potential for tariffs rather?
So I think they consider those two separately, tariffs from the potential for tariffs. So this all harkens back to the USMCA renewal process in 2019. At the time, the Bank of Canada was coming from extremely low interest rates and trying to get back to neutral through its hiking cycle. And you did see this these headwinds from trade uncertainty as those negotiations hit a roadblock, and it looked for a period there like the U.S. might rip up NAFTA entirely instead of reshaping it into USMCA. The Bank of Canada actually studied those proposals quite closely. They included an analysis in their monetary policy report from July 2019, which actually does resemble the current risk scenario quite closely. So that 2019 report looked at a 25% tariff from the US on all Canadian imports and retaliatory tariffs from Canada. Their assessment at the time was that would reduce the level of GDP by about 6% over 2 years. So that can help calibrate how the Canadian economy might fare in the current trade dispute, but it also gives a bit of a glimpse into how they were looking at that at the time.